to Mark Gibson Shumawi's channel. Accountant with designations CPA, MBA, CMA, ACPA, ASA, Australia. Enjoy learning!
Good morning, class, and welcome to your financial market class. Today we'll discuss about determinants of interest rates. So, siguro before we go to the our discussion proper, let's talk about background investigation, or say what are the processes, no, before say a bank grants you your loan, no. So of course, when you apply for a bank loan, sabihin lang natin na simple bank loan, firstly the bank will require you to submit documents, no, documents to support whether to support your capability to pay, no. So ano yan, so for example, you're employed, of course, the bank will require your form 23 BIR 2316 or your income tax return, because in your income tax return it will um, show all your gross income for the year, no, and as well as your net income. What else? Siguro credit card bills, no, whether you're able to pay your credit card dues. So basically all it could also, the bank can also request, um, the bank can also request documents, no, of your belongings or properties. So say for example, you own a condominium unit. Is it mortgage or not? So if it's mortgage, how long will the mortgage be? So yung basically in questions, and that's why it's really important to maintain a good credit standing. So again, no, credit standing encompasses a lot of things, no. So are you able to pay all your bills on time? Blacklisted ka ba in one of your cards? So, and as you know, banks have networks, no. So if you're blacklisted in one bank, there's a good chance that you're also blacklisted in all the network banks. So that's why it's really important to have a good credit standing, no. So one good example as well is are you able to pay your postpaid plans, or are you blacklisted in Smart or in Globe or in any telecommunication companies, no? And as you know, say for example, Globe is affiliated with BPI, and BPI is affiliated with the network of banks, no? So if you're blacklisted in Globe, there's a good chance that you'll also blacklisted in BPI, no? So yun, parang good example lang of how really important to make sure that your credit standing is in good rating, no? So why? Because here in determinants of interest rates, there are other elements, no, that really compose the interest rates, no. Kasi 'di ba, normally in your financial accounting and reporting, interest rates or the nominal rates is simply the rates stipulated in the notes of the, say, of the bonds, no. Pero ano ba talaga, what are the elements that compose that particular interest rates, no? So yun yung pag-uusapan natin in our discussion for today. So determinants of interest rates, of course we have this formula, no, but basically this R represents the interest rates, and then ano ba yung mga factors compose the interest rate, no? So of course we have R, and the asterisk, that's the real risk-free rate of interest, plus IP. It is the inflation premium. We'll discuss that more, no, a little later. DRP, or the default risk premium. Default risk, it's the risk of not being able to pay. LP is the liquidity premium. Liquidity, di ba? When we say liquidity, this is your ability to pay short-term obligations. MRP is the maturity risk premium. So later on, we'll also have example on MRP. Special provision, these are parang sabihin natin all others, no? So it encompasses different things. Now that's why gaya na sinabi ko kanina, whenever we apply for a loan, the bank will require us to provide documentation simply to um, demonstrate our capability to pay. So all of these determinants of interest rates will then be included, in their evaluation. That's why palagi natin naririnig that that interest rates varies, from one person to another. Why? Because definitely we have different also financial standing, and also differences in terms of our capability to pay. So that's the very essence of determinants of interest rates. Okay. So let's talk about the different elements na. No? So remember, we have inflation premium, default risk premium, liquidity premium, maturity risk premium, and special provision. Itong special provisions really case-to-case basis. Ano? Okay, so let's talk about inflation premium first. So an inflation premium is the part of the prevailing interest rates that results from lenders compensating for expected inflation by pushing nominal interest rates to higher levels. No? So inflation premium is simply including a portion of the inflation in the nominal interest rates. No? So imagine, yung inflation nilalagay na doon sa rates being charged to us by the bank. Ay ano nga ba yung inflation? No? So simply, inflation is the rate of increase in prices over a given period of time. So typically, it is the measure of the overall increase in prices or the increase in the cost of living in a country. Kaya nga, in one of my discussions, I think in currency trading, you can look it up in our page. Meron doon concept of Big Mac theory. So simply, Big Mac theory is really comparing the price of McDonald's Big Mac, yung burger, from one country to another, So sabi natin, yung pricing ng McDonald's really depends on the cost of living, in a country. So parang yung example ko at that time is the price of sa akin personally when I travel, ang ginagamit kong basis is a can of Coke, Coca-Cola, kasi 'di ba in the Philippines, bibili lang natin siya for about sabihin lang natin 25 pesos per can, But when I went to the UK, imagine, it cost me 2 or 3 pounds, per Coke, per can of Coke, So that's about 300 pesos. So imagine that, So it's really high compared to the price here in the Philippines. So yeah, so that's inflation premium. So to further solidify our understanding of inflation premium, paano nga ba nako-compute yung inflation premium? So let's have discussion problem 3. So again, inflation premium, basically we're inputting expected inflation high. Di ba? Sabi natin pag inflation, it's the increase in prices. So in problem number 3, sabi, assume inflation is expected to be 5% next year, 6% the following year, and 8% thereafter. Now we're being required to compute for IP sub 1, IP sub 10, and IP sub 20. Now, given the formula as shown in the screen. So let's have problem number 3. Of course, IP sub 0, sabi natin palagi, So if it's 0, it is for the current year, So of course, IP sub 1 would be the inflation premium for the next year. No? So again, what's the formula? The formula is simply, ito medyo complex no kung tingnan, pero in our illustration, ang lalagay lang naman natin as the numerator would be the inflation. No? Or take note of that, inflation over N or the time. Okay, so for IP sub 1, it's 5%. 5% is the inflation rate for next year over 1 kasi nga IP sub 1. So IP sub 1 would be 5%. Okay, so IP sub 10 naman tayo. Pag IP sub 10, take a look at the formula. What we did is, of course, what are given. No? Ang given kasi sa atin is the inflation for next year, 5%, plus the inflation for next following year. No? So that's 6% plus 8% multiplied by the number of years. No? Kasi tingnan mo ha, yung 5% that's year 1, 6% is year 2, and then di ba sabi 8% thereafter. So meaning, and since we're being asked to compute for IP sub 10, kung meron kang year 1 na 5%, year 2 na 6%, yung 8% will represent the remaining years. No? So therefore, 5 plus 6 plus 8% multiplied by 8. No? So that's 75% over N. So N here is 10 years. No? So 75% divided by 10, that would be 7.5%. No? So that's IP sub 10. All right. O sige. Tapusin na natin siguro yung problem number 3. Let's go to requirement number 3. No? So compute for IP sub 20. IP sub 20, so simply, no? So 5% plus 6% plus 8% multiplied by 18. 18 kasi nga naman 20 years yung yung nire-require sa atin, no? So in that case, 155% divided by 20. 20 is the number of years, no? So that's 7.75%. Siguro para lang mapatunayan yung formula natin, let's also compute for IP sub 5. No? So that's 5% plus 6% plus 8% multiplied by 3 over 5 years. No? So that would be 7%. So class, siguro ang kailangan lang na tip or possible na maging tricky lang dito would be the given inflation rate. No? Kasi in this problem, given are 5% for next year, 6% for the following years. And also, take note that IP sub 0 would be the current year. No? So wag magpapalito. Not necessarily IP sub 1, it doesn't represent current year. It represents the following year. No? So that's IP sub 1. Kaya nga I put here, no? Inflation premium, it must earn this IPs, inflation, to break even versus inflation. So that's really the mitigating factor here. No, this is the very reason why they include inflation premium in the nominal rate. No, in order for them to be sure that whatever increase in the prices there would be, so they'll be able to recover it. No? So these IPs would permit you to earn the interest, no, stipulated before taxes. Okay, so that's problem number 3. Okay, so let's proceed with the maturity risk premium. So a maturity risk premium is the amount of extra return you will see maturity risk premium. A maturity risk premium is the amount of extra return you will see on your investment by purchasing a bond with a longer maturity date. It is designed to compensate investors for taking on the risk of holding bonds over a lengthy period of time. So, parang ano lang yan, no? So, you're being at the point of view of the investor, of course, you're holding the bond, no? Meaning you're extending credit for a longer period of time, and in order for you to compensate, no, for allowing or for extending the maturity date, then you earn maturity risk premium. No? So yun lang naman yun. Para siguro mas maintindihan pa, mas ma-appreciate pa yan, let's have problem number 4 on maturity risk premium. No? So requirements, compute for MRP1 or MRP sub 1, MRP sub 10, and MRP sub 20 given our MRP 0.1% multiplied by time minus 1. No? So let's have problem number 4. Okay, class. So MRP sub 1, ayun lang naman din yung formula natin. No? So that's 0.1% multiplied by 1 time minus 1. So 0% for MRP sub 1. Why? Because MRP sub 1, kasi nga, in maturity risk premium, you're actually, this is the rate included in the interest to compensate for longer or for extended maturity date. No? But since this is just MRP sub 1, then it's 0. No? Kasi wala ka pa namang in-extend. No? Parang ganun lang yun. No? Now, for MRP 10, again, it's 0.1% multiplied by T representing the time. So that's 10 minus 1 or 0.90%. So tatandaan lang class itong 0.1% dito, this is not constant. No? So it has to be provided by the problem. MRP 20, so that's 0.1% multiplied by 20 minus 1. So again, yung 20 dito represents the time or the term, no? So the number of years, so that's 20. So that's 1.9%. So the maturity risk premium is increasing as the time to maturity increases as it should be. Well, parang that's logical, no? So the longer the term, of course, the higher the maturity risk premium. Kasi yun nga yung kino-compensate mo. No? So that's problem number 4 on maturity risk premium. Okay, so let's have discussion problem number 5 on appropriate nominal rates. No? So simply, parang ano lang to class, no? Pinapakompute sa atin how much would be the nominal rates, no, given R with the asterisk is equivalent to 3%. No? So ang ginagawa lang natin dito is let's now compute for the nominal interest rates, no? Using the data calculated in problems number 3 and 4. So in number 3, we calculated for the inflation premium, no? So in number 4, we calculated for the maturity risk premium. Now, we're ready to calculate for the nominal interest rates or the nominal rates. Kung napansin nyo class, given is the formula. So parang ano lang to, no? Basic additional lang to, no? So our or the risk-free rate is equivalent to 3% daw. So that's 3% for all. Kasi ginawa natin is R1, this one, no? R10, R1, ito. Then R10. Oops. And then we have R20. Ayan. Oh, and assume the risk-free rate is 3%. No? So that's 3% for all. MRP1 is 0. Saan nakuha yan? Yun. Tingnan lang natin, i-link na lang natin doon sa problem number 3. Oops, not MRP. This is problem number 3. IP1 is 5%. IP10 is 7.5%. And finally, IP20 is 7.75%. Okay, let's also link this. No? MRP1 in problem number 4, that's 0%. MRP10, that's 0.90%. And then MRP20, That's 1.9%. No? So all we have to do, of course, the other elements are not given. No? So probably it's not included, no, in the calculation of the nominal rates. No? So all we have to do here is add the three factors. No? So for R1, let's add 3% plus 0% for MRP1, and then plus 5% for IP1. No? Now the R1 would be 8%. For R10 naman, so that's 3% plus 0.9% plus 7.5% or 11.4%. For R20, that's 3% plus 1.9% MRP20. And then for inflation premium, so that's 7.75% for a total of 12.65%. So napapansin natin dito, class, the longer the maturity of the loan is, well, the higher the rates of interest. No? Kasi nga naman, mas tumatagal, mas lumalaki yung other factors. No? So like, pansinin mo, there's an increase in the maturity risk premium, of course. No? So sabi natin, maturity risk premium is basically compensating no? for the extended maturity period. No? For inflation premium naman, kung napapansin mo, di ba, the amount of peso that you have for today will not be equivalent to the value of that same amount of peso in the future, no? So mas lumiliit siya, so therefore the inflation rate increases, and that's the reason why we have inflation premium also included in the calculation of the nominal rates, no? So kaya the longer the loan, the longer the term of the loan is, the higher the nominal rates. So that's problem number 5. Okay, so let's talk about the unbiased expectations theory. Unbiased expectations theory states that the current long-term interest rates contain implicit prediction of future short-term interest rates. More specifically, the theory posits that an investor should earn the same amount of interest from an investment in a single 2-year bond today as that a person would with 2 consecutive investments in 1-year bonds. No? Parang ganito lang yan, class. No? So, the unbiased expectations theory, ang sinasabi lang yan is, kung nag-invest ka in long-term bonds, dapat daw yung interest na makukuha mo will also be the same to that person who invests in short-term bonds naman, pero of equal terms. No? So, paano yun? Kung halimbawa, si Piolo, nag-invest sa 5-year bonds versus kay Ruru na nag-invest sa short-term bonds. So sabihin natin 1-year maturity. Pero ni-roll over niya. So after maturity in December 2021, ni-roll over niya. Invest niya naman sa another short-term for another year. And then the same amount would be roll over for another short-term till 5th year. No? So sinasabi lang ng unbiased expectations theory would be kung magkano yung na-earn na interest ni Piolo should be equivalent to the amount of interest that Ruru would earn. No? So, yun yung unbiased expectations theory. So again, para mas ma-appreciate yan, let's have problem number 6. So in problem number 6, assume that 1-year treasury bond yields 5%. No? So 1 year lang yan. While a 2-year bond yields 6.5%. No? Investors who want to invest in 2-year bonds has the following options. Option number 1, buy 2-year bond and hold it for 2 years. So ito na si Piolo, no? But in this example is straight for 2 years lang. Yung example ko kanina is 5 years, no? Number 2, buy 1-year bond, hold it for 1 year, and then at the end of year 1, reinvest the proceeds in another 1-year security. So parang lumalabas, parehas din silang nag-invest for 2 years, no? So let's now calculate for the required rate of interest, no? So let's have problem number 6. Okay, so in problem number 6, we'll use this formula, no? Unahin muna natin yung option number 1. Option number 1 kasi this is basic, ano? I think ito yung palagi nyo naman nako-compute na, no? So, paano computein yung rate of interest, required rate of interest, that's 1 plus the interest rate raised to n minus 1, no? So, to translate that, 1 plus 6.5%, 6.5%, no? And then raised to 2 kasi na yung 2 years, no? Then minus 1. So that's equivalent to 13.42%, no? So that's option 1. Now for option 2, in option 2, medyo gagamit tayo ng algebraic expression to compute for the interest rate, no? So paano yan? R2 is equal to 1 plus I plus 1 plus EI raised to n minus 1. So parang gagawin natin, magta-transpose na lang tayo, no? So that's 1.05 plus 1 plus EI raised to 2 minus 1. Ang tip dito, class, is try to do it on your own, no? So that we'll check, no? So we could have the same answer, no? So that's 1.065. Of course, no, yung mas kabisado nyo to, no? You have to transpose na unahin yung 'di ba pag nililipat natin to the other side, nagbabago yung sign, no, ng numbers, no? So that's 1.134225 is equals to 1.05 plus 1 plus EI. Of course, no, in this case, we have to divide the numbers to the left, no? So that's 1.134225 divided by 1.05 is equals to 1 plus EI. So lalabas na ngayon is 1.08021428 minus 1, no? So that's EI. So that's 8.02 plus 5%, no, doon sa year 1. So kung napansin mo, meron tayong 13.02. Pag kinuha natin yung sum ng dalawa, ito kasi this is the required rate of return, no, for 2 bonds na, no. So for these 2 investments na. So that's 13.02, which is more or less the same dun sa option 1, no. By holding 2-year bond and then hold it for straight 2 years, no? So that's unbiased expectations theory. So again, class, please try to calculate this on your own para at least mas maging familiar kayo dun sa way how to calculate the required rate of return using algebraic expression. Okay. Okay, so let's talk about liquidity. Oh, hindi yan liquidity, it's liquidity. Let me correct it now. Liquidity. So liquidity premium theory. Liquidity premium theory states that bond investors prefer highly liquid, short-dated securities that can be sold quickly over long-dated ones. The theory also contends that investors are compensated for higher default risk and price risk from changes in interest rates. Now, simply, ang sinasabi daw ng liquidity premium theory is that bond investors prefer highly liquid, short-dated securities. Of course, no? Kasi nga, diba? The longer that you hold those bonds with you, there's also the elements or chances of default, no? Meaning hindi ka na mababayaran kasi like there are factors, no? Factors beyond our control. Sabihin natin economic or gaya ng nangyari sa atin ngayon, no? So there's the pandemic. Of course, those are factors beyond our control, and sometimes we cannot actually foresee it, no? And that's why kaya nga lagi natin lalagyan ng mga premiums, no, in order for us to calculate the nominal interest rate, no? So let's have liquidity premium or problem on liquidity premium, no? So calculate for the current year and expected 1-year treasury bond rates over the following 3 years. Piolo Capital forecasted that the 1-year treasury bill rates and liquidity premiums for the next 4 years are expected to be as follows, no? So ito daw yung rates for treasury bills with the related liquidity premiums, no? So ngayon pinapakompute sa atin is the required rate, no? So let's have problem number 7. Ito very straightforward ulit. Of course, for year 1, that's 5.6, no? And then for R2, ang gagawin lang natin is, of course, 1 plus R1, and then 1 plus R2 plus L2. L2 represents liquidity premium, no? And then R2 represents the rate, no? So everything's given naman here, no? Then minus 1. No? So we'll just follow the same formula. So paano yun? So that's 1 plus 5.6% or simply 1.056 plus or multiply by 1.067. Ito naman yan sa R2 plus the liquidity premium, no? Itong 0.06 raised to 1 over 2 minus 1. No? So that's R2, no? 6.1784%. Oh, so following the same formula for R3 naman, so that's 1.056 multiplied by 1.067 plus 0.06% multiplied by 1.068 plus 0.08% raised to 1 over 3 minus 1. So that's 6.41%. And then for R sub 4, that's 6.63%. No? So again, following the same formula, so that's 1.056 multiplied by 1.067 plus the liquidity premium of 0.06% multiplied by 1.068 plus the liquidity premium of 0.08%. Ito, careful with the zeros class. Ha? This is 0.08%. So kung in decimal places, that's 0.0008. No? Multiplied by 1.072 plus the liquidity premium of 0.10%, no? Raised to 1 over 4 minus 1 or 6.6331. Ang pansin nyo lang na error ko dito, class, this 5.6%, this is current year. So this is R sub 0. This is R sub 1. This is R sub 2. And this is R sub 3. Kasi ang pinapakompute sa atin is for the current, this is the current, and for the following 3 years. No? This is the following 3 years. Remember, class, no? R sub 0 or anything, no? Sub 0 would be the current year. All right, no? Okay, so that's a liquidity premium, no? So going back to problem number 5, again, if the liquidity premium is given, all we have to do is add it up, no? To calculate for the nominal rate. No? So in this case kasi, previously, ang pinapagamit na sa atin is yung na-compute natin na maturity risk premium and inflation premium. No? So wala pa yung liquidity premium. Like I said, if the liquidity premium is also given, if the default risk premium is also given, all we have to do is add it up, no? To calculate for the nominal rate. So that's problem number 7. Now, let's go to the concept of implied forward rates. Implied forward rate is the rate that gives you the same return at the end of the year, no matter if you choose 1-year T-bill or the 6-month T-bill and roll it over. No, parang it's kind of the same, no, dun sa unbiased theory na pinag-usapan natin kanina. Now, let's illustrate it by problem number 8. Yun nga, using the unbiased expectations theory, 1-year forward rates on 0 coupon treasury bonds for 2, 3, and 4 as of March 1, 2020 were, so that's the requirement. No? Now I flash here, put here the formula, no, to get the implied forward rates. On March 1, 2020, the existing or current spot 1-year, 2-year, 3-year, and 4-year 0 coupon treasury security rates were as follows. No, R1 is 0.553%, R2 is 0.774%, R3 is 0.905% and R4 is 1.278%. No? Basically, pinapakompute sa atin is the rates. So let's have problem number 8. So in problem number 8, again, it looks complex, no? Pero pag-usapan natin yan by way of just calculating it straight. No? So ang pinapakompute sa atin is the rates for year 2, year 3, and year 4. No? So year 2, that's 1.01 plus 0.774%, this rate, no? And then raised to 2. And then the denominator naman, so that's 1.0553% raised to 1. So kung napansin mo, yung sa denominator, we use, no, the rate from the previous year. Okay, so the implied forward rates would be 0.995%. F3 naman, again, following the same formula, so that's 1 plus 0.0905 or 0.905% raised to 3. 3 is the number of years, and then the denominator again will use the rate from the previous year, or in this case 1 plus 0.774 raised to 2 or 1.168%. Okay, next is 1 plus 2.78% raised to 4 divided by 1 plus 0.905% raised to 3, or equivalent to 2.405%. So that's problem number 8 on implied forward rates. And actually that ends our discussion on the determinants of interest rates. Again, if you have any questions, please feel free to send me an email or send me a chat on Viber or in my Messenger account. So thank you again for attending my class, and stay safe, everyone. Thank you.
This has been your instructor, Mark Gibson. Thank you for learning with us. See you in our next discussion. Don't forget to like and subscribe. See ya!